I think stemming the tide and reversing the tide are two different things. So what the BOJ has done is to intervene at moments when the market was very shallow, and it has reversed the downward decline in the yen. But that's not really out of the woods yet. If you really want to tighten monetary policy, then you have to tighten it. You can't do it through currency intervention unless you use a technical thing called unsterilized intervention. And there's really no sign of that. So what I think the Japanese yen is doing is, and I think what the BOJ has achieved, is to put a floor under the yen for the moment, because it has raised the risk of being short the yen, but it has not put the yen on a firm footing, because to do that would require much higher short-term rates, probably about 50 basis points, and obviously higher longer-term rates too, which a reduction in the BOJ's buying of JGBs would achieve. But we're not there yet. The risks are still quite high in the yen, in my view.
David, to your point around just stemming the tide here, central bankers that I've spoken to point out that it does send a message to currency traders. If you are active in the market, they don't want to bet against you. What do you make of that approach of doing absolutely nothing versus targeted interventions?
Well, I think if the Japanese central bank had done absolutely nothing, the yen would be at 165 and below. And at that point in time, of course, the whole operating framework, the whole reaction function of the Bank of Japan is out of the window, because what they hope is going to happen is that the higher wages, which we've seen, will feed through into higher income for households, and that the households will go out and spend that income, so feeding back into higher inflation. But if the yen were to continue to weaken, then the feed through into inflation would be such that the households would not spend the added income they get from wages, they'd put it in the bank. And then the whole idea of Japan generating a higher rate of inflation, the only central bank in the world to be really targeting a higher rate of inflation, but that endeavor would simply come to nothing if that were to happen. That's why they have to stop the yen falling.
David, I love history, which is, I'm sure, something you love as well. Good morning to you. It's like it's back to the future, isn't it? An expansionary Reagan and a tight Volcker calling for, and then we had G7 intervention. Are we in Plaza Accord territory? Are we back to 1985,
no.
David?
No, and of course, I suppose that you and I are the only people in the studio, and probably within 50 miles of it, who remember all the Plaza Accord shenanigans. But we're not, and I'll tell you why we're not. We're not because if you look back to the G7 meeting a couple of weeks ago, they had a kind of wishy-washy, wimpy breakfast in which they said, all the G7 members, it's terribly naughty to short currencies, which are really very good currencies, and you really shouldn't do it. But that was the sum total of the intervention. Nothing happened in the markets. If you wanted to have a Plaza Accord repeat, you would have to have a united effort and united intervention by the G7. That you didn't. And the reason you didn't is because the G7 considers that Japan's plight, the risks to its policy of resetting inflation higher and getting a more vibrant economy, if you could apply such a term to the Japanese, is entirely in Japanese hands. That the problems they face are of their own making. And the G7 is not going to take that on board and say, reverse Fed policy, cut interest rates dramatically in order to save the yen. Nothing like that is on the books. The Japanese are on their own.